Many investors buy index funds as a way to avoid individual stock picking and as an easy way to diversify. The most common fund to buy is the S&P 500, and investors who choose this fund may be shocked to find out that over 16% of their money is in the top 3 companies, and over 20% of their money is in the top 5 companies. This may be a higher weighting than a lot of these investors would want. But is there a good alternative? Stay tuned and we'll discuss this and more. There are 2 basic types of index funds or ETFs that we need to understand. The first is called cap-weighted or market capitalization weighted. In this type of fund, each holding is sized proportionally to its relative size in the market. So a larger company is going to take up a larger percentage of the overall index. On the other hand, in an equal weighted fund, it's going to have the same number of holdings as its market cap counterpart, only in this fund, every holding is the exact same size, hence equal weight. Let's begin with an example. The S&P 500 is perhaps the most popular market index. The traditional S&P 500 is cap-weighted, meaning that each holding in the index is sized proportionally to its relative size in the market. In order to calculate it, you take Apple, 2.5 trillion, Microsoft, 2.2 trillion, Amazon, 1.9 trillion, and so on and so forth all the way down to the number 500 largest company. If you add up their market caps, you'd arrive at $44 trillion. Now, just move the decimal point over 10 places and you have the S&P 500 index value. The true calculation of the S&P 500 is a little bit more complicated and takes into account share buybacks and various other factors, but this is basically how the calculation is made. An equal-weighted S&P 500 fund, on the other hand, is much easier to understand. It has the exact same 500 companies as the traditional S&P 500, only now every holding is exactly 1/500th or 0.2% of the overall index. Now, let's take a look at a list of pros and cons so you can get a better feel for how all of this works together. And as you'll see, sometimes the cap-weighted pro is the equal-weighted con and vice versa. With cap-weighted funds, winners that continue to win become a greater portion of the index. When mega-caps do well, a cap-weighted fund does well. The largest cap companies have less volatility, so a cap-weighted fund will have inherently less volatility than an equal-weighted fund. Finally, it embraces large cap bias. In an equal-weighted fund, winners are punished in the sense that their gains are sold off to redistribute to keep weighting even across the fund. When mega-cap companies are crushing it, equal-weight funds miss out on these gains. Finally, equal-weighted funds have greater volatility due to greater exposure to smaller, higher beta companies. Now for some equal-weighted pros. Outperformers are sold and capital is deployed to equalize weighting. Essentially, this forms a buy low, sell high mentality. Next, there's greater exposure to smaller S&P 500 companies which offer greater growth. This pro, by the way, seems to overshadow the drawback of winners getting sold off. And finally, equal weight eliminates the large cap bias. With cap-weighted funds, there's a buy high, sell low mentality because the fund is forced to buy outperformers as their size increases. Next, there's reduced exposure to smaller S&P 500 companies, and this seems to reduce overall returns. Let's take a look at a couple charts now to see how market cap and equal-weighted funds seem to perform relative to the other. You can see here the performance of each of these 2 funds relative to each other. The equal-weighted fund is in red and the market cap-weighted fund is in blue. The fund VADAX seems to provide the longest history of an equal-weighted S&P 500 fund's return. However, the fund has a 5.5% front-end load, so it probably wouldn't be the fund that I would choose if I were to use an equal-weighted fund. Nevertheless, over this 18-year period, you can see that $100 invested into the cap-weighted fund grows to approximately $300, and that same $100 invested into the equal-weighted S&P 500 fund grows to almost $450. This is pretty significant outperformance. If you look at some of the characteristics of the chart, though, you can see that during bull runs, the equal weighted fund seems to significantly outperform, but during market downturns, because of that greater small cap exposure, it seems to experience greater downside. This definitely needs to be taken into consideration if a person were to choose an equal weighted S&P 500. This other chart shows us some similar information, only now the traditional S&P 500 cap-weighted fund is compared against an ETF instead of another index fund. There is not as many years of history with this ETF fund, RSP, but if I were choosing an S&P 500 equal-weighted fund, this is the one I would use because it has lower overall expenses. So, now that you have a better theoretical understanding of cap-weighted and equal-weighted funds and you've seen this play out with real data, it's important to ask yourself, what do you do with this information? For me personally, I want to do a little bit more research. I want to see if the mechanisms that have caused the equal-weighted fund to outperform over the last 20 years is going to continue into the future, or if there were special circumstances that have caused it to outperform over the last 20 or 25 years. But I gotta admit, I don't really think that there is any particular reason to have caused it. I think it just might be that the equal-weighted fund is stronger. But I want to do a little bit more research before I make that final conclusion. And the answer to this question matters a lot to me because there's going to come a time when in the future I'm financially independent and I don't want to take the time to do, research all these companies and pour all the time and effort and energy into it. And I just want to put all my money in an index fund and let it ride. And when that day comes, I need to know, do I want to put it in a market cap S&P 500 or an equal weighted S&P 500? There is skin in the game for me with regard to the answer to this question. Thank you so much for watching. If you made it this far in the video, please like the video. Don't forget to comment as well as subscribe. Let's finish the video with a portfolio review. What's going on, everyone? It has been a week and a half since the last portfolio review. Two of my biggest three holdings, Corsair Gaming and Dropbox, have reported earnings. Dropbox reported very strong earnings, beating on almost all numbers and having strong guidance moving forward. And Corsair Gaming had a slight beat on revenue, but a slight miss on EPS. Its share price has been unfairly punished in my opinion, but that's no problem. I'll gladly swoop in and pick up some more shares. By the time you watch this video, Tattooed Chef will have reported their earnings. They'll be reporting after the bell on Thursday, August 12th. I'm recording this on Wednesday, August 11th, and I'll be going into more detail on all three of these companies' earnings in a future video next week. I'm currently in the process of leaving Robinhood, but the transfer of my assets had a slight hiccup. I've got to fill out a couple forms in order to have that process continue in the future. That process will be completed in the next couple weeks, and in the meantime, I'm not able to make any trades or deposit any funds. Once that is completed, though, I'll make a dedicated video on how to transfer money out of Robinhood or any other broker for that matter, so stay tuned for that video coming soon. The final thing I'd like to mention today is on Smile Direct Club. They missed on earnings and have just been absolutely devastated over the last couple months. Smile Direct Club had a data breach a month or two ago, and more recently they had a few workers who were shot in a workplace violence event. So this company has just faced one struggle after the other, and the share price has gotten beaten down. I've been following this stock since shortly after it IPO'd, and I've been an owner for quite some time now, so I still like the company moving into the future. It's currently a small position of mine, but I may be adding more shares going forward. If you've made it this far in the video, thank you so much for watching. Please don't forget to like the video, comment down below, and consider subscribing. Until that next one, peace.